Hi, I'm Jennifer Boylan, a realtor at Boylan & Company. Here at Boylan & Company, we feel it is essential to help our clients understand those things that impact their real estate investments, even if it is just their primary residence. We know that when it comes to real estate, knowledge is power. So the more our clients know about real estate, the better they do in real estate. Finance can be one of the most confusing aspects of real estate, so our goal in this series will be to simplify and demystify the mortgage process. Any attempt to understand the subject of mortgages has to start with a look at insurance. As we've seen in the last couple of years, there is a lot of risk involved for the institutions that lend money. As investors, these institutions need to hedge their risk, and they do so with mortgage insurance. Mortgage insurance is an insurance policy paid for by the borrower for the lender. The purpose of this policy is to offset potential losses if a borrower is not able to repay the loan. Mortgage insurance can be either public or private depending upon the insurer. This is one of the factors we look at when deciding what type of loan is best for you. Let's start with private mortgage insurance. For-profit, non-governmental institutions underwrite private mortgage insurance policies. These are big companies like GE Capital or Genworth Financial. A private mortgage insurance policy is used to secure a conventional loan. These are the loans that cannot be insured by the government. The cost of private mortgage insurance varies based upon a number of factors, and contrary to popular opinion, private mortgage insurance can ultimately be less expensive than a government-backed policy. Here's a list of factors associated with pricing a private mortgage insurance policy. Loan term. This is the length of the loan. 15 and 30-year mortgages are the most popular. Loan type. Fixed or adjustable rate. We will talk more about these in another video. Proportion of the total home value that is financed. This is known as loan to value or LTV ratio. This expresses the amount of a first mortgage lien as a percentage of the total appraised value of real property. For instance, if a borrower borrows $130,000 to purchase a house worth $150,000, the LTV ratio is $130,000 divided by $150,000, or 87%. The coverage amount. This is determined by the lender and based on the loan-to-value ratio. The frequency of premium payments, either monthly, annual, or single. A good loan officer will help you play with these numbers in order to structure a loan that best suits your situation. Now let's take a look at down payments. The downside of a conventional loan is that in order to be affordable, these loans generally require more money down. So if you don't have the cash, a conventional loan might not be for you. The most common down payments made are 5%, 10%, 15%, and 20%. In general, the higher the down payment, the lower the mortgage insurance will be. In most cases, if borrowers put 20% down, there is no requirement for mortgage insurance. Typical rates for private mortgage insurance policies are about $55 a month per $100,000 financed, or as high as $1,500 a year for a typical $200,000 loan.